Hello from a really rather glorious Thursday the 26th. I'm FX Blue and this is the market brief. So the Bank of England has started to look at the UK banking market through a post-Brexit lens. They're looking at reducing the capital adequacy requirements for banks that retrench back to the UK. This would naturally free up capital, which should fuel increased lending. The hope is that as the economy recovers after the COVID issues and cash-hungry businesses reopen and ramp up once again, this should provide access to lending facilities that will support these firms until cash flow increases once again. Now, it all sounds very good, but we have been here before. Remember, previous initiatives to increase bank lending have been hampered where the COVID-affected borrower their risk profile has not met the lending criteria of the banks. But we'll see. Dominic Cummings has been on. The former chief advisor to the Prime Minister launched a rather blistering attack on the government's approach to the pandemic. Dear old Boris and Health Secretary Matt Hancock were in his crosshairs, but he didn't quite manage to escape further questioning about his now infamous trip to Barnard Castle, where he riled most of the country by breaking the first lockdown. Meanwhile, the market has fallen into something of a lull, waiting to see the effect of rising inflation. Sterling seems to lack sufficient support to really test the pretty strong resistance now around the 142 level against the dollar. We kick off this morning at 141.20. In the US, the market is awash with data, which will no doubt fuel speculation over what the Fed may do when they next meet in mid-June. A more pragmatic view is, of course, that it's still too early for Powell to provide more advanced guidance, and certainly too early to act. He has confirmed on many occasions that the Fed won't be drawn by individual data sets. Instead, they're looking at the wider trends. And speaking of, employment remains a major focus as the non-farm payrolls have seen some pretty wild swings over the past few months. And accompanying speculation is that the jobs market may take longer to return to normal than originally expected. Bertie, this way, mate. That kind of sits in line with the Fed's wait-and-see attitude. Jobless numbers, the weekly jobless, that's all moving in the right direction though. The 4-week average and the headline numbers are both trending lower. The dollar index looks to be regrouping as the market wants the Fed to provide a more hawkish outlook for monetary policy before any recovery will crack on from here. Yesterday, the index trod water around 90 and euro-dollar moved back to the 122 level, which is where we reopen today. Right, that's it from me. Have a nice day, enjoy the sunshine if you can, and do join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue.